75 data center projects, $130 billion, blocked or delayed in 3 months flat. That's not a permitting delay, that's a revolt. Before we dive in, I need to be clear, I am not a financial advisor. This video is for educational purposes only. Investing involves risk, so always do your own research before making any financial decisions. Okay, so here's what nobody's really saying out loud yet. The AI growth story, the one quietly running your 401k. Whether you asked for it or not, just ran into your actual neighbor. The one with the hand-painted signs staked in his front yard. You've probably seen the headlines about chip stocks ripping higher. Nvidia, Broadcom, the whole AI infrastructure trade. But there's a second story running underneath that one, and it's a lot less glamorous. It's your electric bill. Let's start with the stat that should stop your thumb mid-scroll. A research group called Data Center Watch found that in the first 3 months of 2026, grassroots opposition blocked or delayed at least 75 data center projects nationwide, worth about $130 billion combined. Most disruptive quarter since they started tracking this back in 2023. That single quarter roughly matched everything blocked or delayed across all of 2025 combined. And here's the wild part, the number of active opposition groups fighting these things more than doubled in a year, jumping from roughly 400 to 833, spread across 49 states. So what does that actually mean for you? It means the "I can't be stopped" narrative you keep hearing. Well, that's just not the full picture anymore. It's hitting walls, real ones, zoning boards, planning commission meetings packed with people waving printouts of their utility bills. Oh, here's one that stuck with me. A guy named John Steinbach lives in Manassas, Virginia, right in the thick of Data Center Alley, the densest cluster of these buildings on the planet. His electric bill jumped from about $100 a month to $281 in 1 month. Lived in that house almost 40 years. Never seen anything close to that. He's not the only one. There's a retired couple out in Granville, Ohio, Ken and Carol. Ken keeps a spreadsheet of every electric bill going back 5 years because that's just who Ken is, and his rate climbed from about 11 cents a kilowatt hour in 2020 to 19 cents now. That's a 60% jump. Carol counted it herself, 130 data centers going up around central Ohio alone. Here's the mechanism, and honestly, it's kind of infuriating once it clicks. When a data center needs power, the grid operator has to build new transmission lines, new substations, sometimes entire new plants. In most states, those construction costs don't just land on the tech company that wanted the building. They get spread across everyone on the grid. You, me, the dry cleaner 3 towns over. We end up subsidizing the build out whether we've ever opened ChatGPT or not. And there's real data behind this, not just anecdotes. A Bloomberg analysis found electricity prices in the areas with the heaviest concentration of data centers jumped 267% over 5 years. In the mid-Atlantic power market, the one covering Virginia, Ohio, Pennsylvania, and a chunk of the Midwest, the wholesale price utilities pay just to lock in future power capacity went from about $29 per megawatt day to over $329. That's not inflation. That's a different planet entirely. And it's not just households getting squeezed. A plastics manufacturer called Plaskolite watched its annual capacity charges at plants in Ohio and Pennsylvania jump from around $200,000 to nearly $1.2 million in a single year. That's the kind of number that decides whether a factory stays open, expands, or quietly relocates somewhere cheaper. And just a couple weeks back, PJM, the grid operator covering 13 states, had to ask customers to voluntarily cut back power use during a heat wave because demand was pushing the system right up to the edge. So what does that mean for you? Even if you're nowhere near a data center, higher wholesale costs ripple outward through the entire grid, and this isn't a one-quarter story either. Utilities have penciled in something like $1.4 trillion in grid spending through 2030, largely to handle this demand, and in 2025 alone, they requested a record $31 billion in rate hikes, more than double the year before. Goldman Sachs is now forecasting electricity prices climb another 6% through 2027 on top of what's already happened. For lower-income household, that hits different electricity already eats up a bigger slice of their budget than it does for everyone else. This is a decade-long bill showing up on your kitchen counter, not a one-time spike you wait out. Here's a wrinkle skeptics like to bring up though, and it's a fair one. Utilities across the country logged requests for more than 700 gigawatts of new power connections last year alone. That's more electricity than the entire United States consumed in all of 2023. But plenty of industry watchers think a big chunk of those requests will simply never get built. Developers sometimes file with 3 or 4 different utilities at once just to hedge their bets on wherever land and power line up fastest, then quietly drop the rest. So some of this grid spending might be reacting to inflated, speculative demand rather than demand that actually materializes down the road. If that's true, ratepayers could end up covering infrastructure nobody ever actually uses, which, if you ask the guy in Manassas paying $281 a month, is its own special kind of infuriating. Would you support a new data center in your town if it brought 200 jobs, but your electric bill jumped 40%? Oh, that's not a hypothetical anymore. That's the actual trade-off sitting in city council chambers right now, and there's no clean answer to it. I want to be fair here, because we don't do one-sided takes on this channel. The industry's response isn't too bad, deal with it. Microsoft publicly promised back in January its data centers won't drive up local rates. Anthropic, the AI company, said it'll cover electricity price increases tied to its own facilities, though the details on exactly how remain thin. There was a whole White House event where major tech CEOs signed on to something called a ratepayer protection pledge. And in Congress, get this, Josh Hawley and Richard Blumenthal, about as far apart politically as 2 senators get, teamed up on the GRID Act, aimed at legally separating consumer bills from data center costs. But, and here's the skeptical part, a pledge isn't a law. A company promising to cover rate increases isn't the same as a regulator forcing them to. Critics point out these commitments are voluntary, light on enforcement, easy to quietly walk back in 2 years when nobody's watching the follow-through anymore. We've watched this movie before. Remember when half of corporate America pledged carbon neutrality by 2030? Yeah. How's that tracking? Do pledges like this actually protect you? Or are they just enough good PR to take the wind out of local opposition before the next election cycle? Genuinely worth sitting with, because the answer probably depends on whether anyone's actually checking the receipts in 3 years. Meanwhile, the political fight is moving fast. More than 300 data center related bills hit state legislatures in just the first 6 weeks of 2026. Maine's legislature actually passed a moratorium on big permitting. Governor Janet Mills vetoed it in April, though she said she'd have signed a version carving out one specific local project with community support. At the federal level, Bernie Sanders and Alexandria Ocasio-Cortez introduced their own moratorium bill. None of it's law yet. This is happening in your state right now, whether it's made your local news yet or not, but the direction of travel is unmistakable. Here's the hidden story most people scrolling past this headline are missing entirely. If even a handful of these moratoriums pass, or if enough small towns just quietly rewrite zoning the way a few already have, the pace of data center construction slows down. And data center construction is the physical foundation the entire AI trade sits on. Every chip NVIDIA sells eventually has to live somewhere with power and cooling attached to it. Slow the buildings, and eventually you slow the orders. That's the thread connecting your rising utility bill to the number on your brokerage app 12 or 24 months from now. Now let's actually talk about that brokerage app number, because this backlash isn't happening in a vacuum. It's colliding with a market that's already jumpy as hell. Back on June 5th, tech stocks had their worst single session since October. AI-linked megacaps shed hundreds of billions in value in one day. Broadcom, one of the biggest AI infrastructure names out there, gave weak guidance and got absolutely hammered for it. A stronger than expected jobs report spooked everyone into fearing the Fed holds rates higher for longer, and that hits expensive growth stocks hardest of all. So what does a rough day like that actually mean for you? If you glanced at your 401k balance that week, you probably watched it dip right along with everyone else's, even if you've personally never picked a single stock, because index funds don't discriminate between the AI names and everything else riding along with them. And then, plot twist, it came roaring back. We are looking at what felt like a market crash that, well, let me actually rephrase that, because it wasn't a crash. It was more like a gut check that reversed almost as fast as it started. Within days, the chip index that had dropped 10% recovered hard, partly on news NVIDIA was joining the S&P 500, partly because Amazon, Google, Meta, and Microsoft reaffirmed something like $750 billion in AI infrastructure spending for this year. So, which is it then? Bubble popping, or just a normal gut check in an expensive market? Honestly, I'll be straight with you. Nobody actually knows for certain, and anyone telling you with total confidence probably wants something from you. Here's the bear case, and it's not a fringe one. The Shiller-Cape ratio, a valuation measure weighing prices against 10 years of earnings, crossed 40 last year. That level's only been hit once before in history, right before the dot-com crash. The top 10 companies in the S&P 500, 8 of them basically tech names, now account for more than 41% of the index's total market value, according to JP Morgan Asset Management's own numbers from early June. At the peak of the dot-com bubble, that kind of concentration was meaningfully lower, back around 25%, and there's a spending gap nobody loves discussing out loud. That same JP Morgan note pegs total AI-related capital spending industry-wide jumping 78% this year alone, from $416 billion to $739 billion, against something like $100 billion in actual enterprise AI revenue collected so far. That gap has to close somehow. Either revenue catches up or spending gets cut. Here's the bull case, and it's legitimate too. Unlike the dot-com names, which mostly had a story and basically no revenue, today's AI leaders are wildly profitable. The Magnificent Seven's net margins sit above 25%, almost double the S&P average. Chip stocks specifically trade around 18 times forward earnings, which is actually cheaper than the broader market right now. In a classic bubble, valuations sprint way ahead of earnings expectations. That's not really what's happening in semiconductors at this exact moment. Is this innovation or is this speculation? Genuinely sit with that one, because I think it might be the single most important question in this entire story. And smart, informed people land in completely different places on it. There's also a whole layer of this happening away from public stock tickers entirely. AI model makers are raising private funding at valuations that reportedly make even the loudest public market bulls a little nervous, with a wave of mega IPOs said to be lining up behind them. None of that shows up directly in your 401(n) statement, but it shapes the mood the entire public sector trades on, because private market euphoria has a way of leaking into public sentiment eventually, for better or worse. Here's where it connects back to your actual life, even if you've never bought a single tech stock in your life. If you've got a 401(a) sitting in a target date fund or an S&P 500 index fund, which, let's be honest, most of us do, because it's the responsible, boring thing to do, you're exposed to this heavily. When the top 10 stocks make up more than 41% of the index, and most of those 10 are AI names, your safe, diversified retirement account isn't quite as diversified as the label suggests. That's not fear-mongering. That's just arithmetic. We've watched some version of this movie before. Railroads in the 1800s, massive overbuilding, most of the companies that laid the track went bankrupt, and other companies bought up the rails for pennies and made fortunes running trains on infrastructure they didn't have to pay to build. Fiber optic cable during the dot-com years is the closer parallel. Companies laid so much of it that a huge chunk sat completely dark and unused for close to a decade afterward. The internet itself turned out to be real, obviously. But remember pets.com? The technology thesis was right. The specific companies riding the hype mostly weren't the ones that survived to cash in on it. The infrastructure boom was real both times. The transformation was real too, eventually. But an enormous number of individual investors got wiped out in the gap between the technology is genuinely real and the specific company I put my money into turns out to be the winner. That distinction matters more than almost anything else in investing. And right now, it's exactly the distinction getting blurred by the hype. There's a quieter number sitting underneath all of this that I actually think matters more than the stock chart. At the end of May, the market hit all-time highs. In that exact same window, University of Michigan consumer sentiment hit an all-time low. Wall Street, euphoric. Main Street, running on fumes. Two things happening at the same time, in the same country. That gap might be the real story here, more than the protests, more than the chip rally. So where does that leave you practically? Not with a stock tip, I'm not giving you one, and honestly, be suspicious of anyone who does with total confidence. What I'd actually push you to do is 4 things. First, pull up your actual 401(k) holdings and check your real exposure to mega cap tech. Don't just assume index fund automatically means diversified, because right now it might not mean that the way it used to. That's 10 minutes on your provider's website, not a financial planning degree. Second, if you live anywhere near a proposed data center, your local utility commission meetings are public record, and that's genuinely where a lot of this gets decided quietly, months before it ever becomes a headline. Show up, or at least read the minutes. Third, go read the actual capital expenditure numbers hyperscalers report each quarter, not the press release version, the actual filing. Compare what they're spending against what they're earning back on it. That gap either closes or it doesn't. That's basically the whole ball game, and it's sitting right there in public documents for free. Fourth, and this is the one people skip most. Check your own electric bill against last year's, line by line, before you assume a rate hike is just inflation. Sometimes it is. Increasingly, in certain zip codes, it isn't. This isn't a story with a clean ending yet. It's still being written, county council by county council, utility bill by utility bill. Nobody, not me, not the bulls on financial television, not the protesters with the signs, actually knows how this settles. Whatever you decide to do with your own money, do it because you actually looked at the numbers yourself, not because some guy on YouTube, me included, told you how to feel about it.